The Fed's two-day policy meeting wraps up later today. The central bank is widely expected to hold rates steady because of persistent inflation pressures. For more on this, we want to bring in Dan Tarullo. He is a former Fed governor who led the central bank's reforms in the wake of the financial crisis, including the implementation of Dodd-Frank. He's now a Harvard law professor. And Dan, let's talk through what we're seeing. The data that we got yesterday suggested that inflation is going to be a hard beast to try and tamp back down. What do you think?
Well, Becky, it sure does look as though the old, almost cliched view that the last part of the battle is the hardest is what's happening here. There was pretty good experience, particularly through the second half of 2023. But that's obviously stalled out, and it's obviously been reflected in what Chair Powell has been saying over the last few weeks. And I anticipate it'll be reflected in what he says at 2:30 this afternoon.
Larry Summers, the former Treasury Secretary, tweeted out yesterday after the ECI and the housing price inflation figures that he's concerned rent prices could actually start to rise again. Those rent prices have been keeping inflation lower on the levels that the Fed's really watching. But he just worries that everything you're seeing at this point, there are bottlenecks that with higher interest rates and higher unit prices, rents at some point are going to reaccelerate too. Do you share that concern?
Probably not as much as Larry does, but I think, the housing market, Becky, has been really hard to track. Well, it's easy to track, but hard to predict. And I think that's in part because of the cumulative impact of the pandemic and then the much higher interest rates. So when you have that kind of effect on the sales market, there's obviously a trickle down to the rental market. And we've seen, we saw pretty significant swings. So I do share some of Larry's concerns that you may begin to see a reacceleration, which is obviously not what the Fed and many others had been anticipating.
Right now, the Dow's indicated open down by about 56 points. We saw a change. All morning long, we've been looking at weaker futures. All three of the major averages paired some of their losses after the number we got from ADP at 8:15. Now, ADP was a little stronger than expected in terms of the jobs that were created, but the wage component didn't increase. It was at 5% for people who were changing jobs. Is that enough of good news to make people think, OK, this is better? I mean, we're trying to figure out what the expectations are from the Fed and how the market will react to that today.
Yeah, I can't imagine. I mean, for multiple reasons, I can't imagine the ADP print is going to have much of an impact on what the Fed does today or even what Jay Powell says today, except perhaps in response to a question. Maybe it was regarded as a bit of an offset to the ECI report, which obviously was not so favorable. But I wouldn't put this is the classic case of not putting too much stock in one report. Becky, I think essentially where the Fed is going to be at now is that they've got to continue to say they're data dependent, because that's what they've been saying now for the better part of a year and a half. And they've become a bit data captive, actually. And right now, with the recent three inflation reports, with the ECI report, I don't think they've got any choice but to sound either, I want to say, less dovish or more hawkish than they did not so long ago.
What do you think Jay Powell's message will be today? How pointed or maybe how oblique?
Yeah, I think, again, I'm gonna refer back to what he said before the blackout period, which is where he seemed to be positioning the FOMC, was to say, look, we're in a place where we can stay higher for longer if that's what the data tell us is needed, or if the labor market begins to weaken, we can react. So that suggests that that's going to be the principal message. And if you don't see too much change in the FOMC statement, and that's the kind of lead that Jay has in his introductory remarks, then I think that's basically where we can expect to be. That is, they're going to wait for better data. The thing that might happen, I don't expect it to, but the thing that might happen is that you're getting some pushback from some of the members of the FOMC who are a little bit more worried and would like to see a little bit of ramping up of the language in the FOMC statement. So that's the thing I'd be looking for. You know, we always say it's not what the FOMC statement says; it's what it says that's different from the last one.
Right, right. Nuance, looking for nuance everywhere. Professor Tarullo, thank you.
Looking for redlining, basically.
Redlining, yeah. Basically run it through the machine learning quickly. Show us the changes.